Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey everybody, welcome back to the Get Real Podcast. Ron Phillips here. Folks, we're moving into spring. I'm very excited about it. I love the sunshine, kind of a reptile in a way. I'm cold unless there's sun. So I enjoy it when the sun's shining, and it is shining. I think the sun is just shining on 2025 in general. It feels better out there. This weekend, I was reminded of something that I get almost weekly. I have to have this conversation with someone. I was just having this conversation with my investment specialists. I have a team of investment specialists who help people understand why they should invest in real estate and then help them do it. And on my team, we were talking about this. Like, one of my folks was talking about the returns of real estate, talking about cash return, your rental property return. Tenant pays you some rent and you pay all of your expenses. You're left over with some cash flow. You divide the amount of net cash flow you have by the amount of money that you invested, and you get your return, right? And these days, that return's not as good as it was in 2012, right? I mean, it's somewhere between 6 and 10%, generally speaking, which isn't horrible. It's pretty good. But it's the totality of real estate that really is why it's so good. And one of the questions I got was, "Hey, look, in my stock account, I'm getting more than 8% over the last several years. So it's better than real estate, because you just told me that. I mean, this property here is 7%. I'm getting 1% better in stocks. Why in the world would I do real estate when the return's not as good?" Keeping up with the theme of last week, one of my friends, Mark Lane, who has no idea that I just said his name on my podcast, but he's a good guy, and he puts out some really good content. Last week, he put out something in a way that I have said on the show, but it's a little bit different. And so I thought I'd share it, because I think it puts into perspective the answer to the question this other guy had, and that we get all the time. I mean, literally, we get this question all the time, and for some reason, it's very difficult for people to wrap their heads around. So as I read his post, I thought, man, this puts it into a really good perspective for people. So he says, based on a $20,000 investment, here's how other investments match up. Okay. Cash, if you got money, cash sitting in the bank, it's literally getting eaten up by inflation. It's worth less every single year. And while, Elon Musk and Doge say they can eliminate the inflation that we've seen, the rise in inflation over the next couple of years as they cut back on waste, fraud, and abuse. I do think that'll help, but I don't think it's going to get rid of it. I think the numbers are pretty baked in for quite a while. I'm happy that they're doing what they're doing and chopping. And I frankly don't understand why people are upset. He's finding billions of dollars of waste. I was in the military from 1992 to 1995. Yes, that's how old I am. And I remember back then thinking, just in my little world of the vast military, the vast DoD budget, I couldn't help but think to myself as a 18-year-old kid, I'm just sitting there watching so much waste. I mean, a lot, but nothing like what they've been finding. Just wait till they get to the DOD. Wait till they get to the Pentagon and the DOD. Oh my gosh, I can't. Whew. All right. That's an aside. Anyway, that's why our cash is worth less. So moving on to a CD, average return 4. And that's right now. I mean, they've been significantly less than that over time, but currently, you don't have any asset, you don't have any ownership, and you get some interest. Not much interest either, 4%. So again, you've got cash sitting in a CD. So you have cash on the that is being eaten up by inflation that we just talked about, getting 4%, which is not enough to actually keep pace with inflation. So you're still literally losing money. You've got an index fund, average return of 8 to 10%. I don't believe those numbers. I know that the index funds say that they do that, but they get to play all kinds of games to be able to legally say that they make 8 to 10%. They really don't. Still really don't have an asset to speak of. You don't have any control because you have a tiny share in multiple companies and you get some interest from the index fund. You've got annuities, which I hate, but they have a average annual return of 5 to 7%. Again, today they do, but over time, they haven't done anywhere even close to that. Still not really any asset. It's guaranteed by an insurance company, which is fantastic. And then you get a payment of, somewhere between $1,000 and $1,400 on that $20,000 investment. Now you've got stocks, and this is where it gets kind of confusing because I find that people in their minds, they think of, when they think of investment real estate, they think of cash flow. Okay. Because if you own investment real estate, the only thing that's ever reported to you is your P&L, your profit and loss from the property management company. And that's income, right? So you have your income. On the stock side, most people don't own dividend producing stocks. They really don't have any income. They have capital appreciation. They have growth in the stock. And that's calculated as a return. The interesting piece of this is when comparing the two, they compare those two returns, which are not similar at all. In reality, if we were to compare more of an apples to apples approach, we would be comparing the dividend produced from owning $20,000 of a stock that produces a dividend, because dividend would be the same type of return as the cash flow with real estate. Make sense? So that's not really what happens. People say, well, my stock went up X percent and your cash flow over here isn't the same. So that was the scenario when we started this conversation today. Remember, it was my stock went up 8% or 10% or whatever it was, and your cash flow over here is only 7 or 8%. So the stock is performing better. Well, let's wait just a second, right? Let's go through this a little bit at a time. Again, two pieces to a stock typically don't exist at the same time: growth and a dividend. Most of you listening, you don't own dividend producing stocks. If you do, they're not seriously growing typically. And even if you do, your dividend is probably not great. It's probably on par with what we're talking about with the cash return on investment from the cash flow. Well, my buddies, he puts in here, look, the $20,000 actually can purchase and control a $100,000 asset. Now that's important because the gain, okay, or the appreciation, the capital appreciation, the capital growth, which would be similar to the capital growth of your stock, okay? Let's say it's 5%. Well, 5% would be calculated not on the $20,000, but on a $100,000 value of the property. So you invested $20,000, but you're getting a return on the 100, right? So it's 5% of 100, or roughly $5,000. And $5,000 divided by $20,000 is a 25% return. Did I do that right? Is it 20 or 25% return? Sorry, it's late in the day, guys. It's either 20 or 25%. Y'all can put it in the comments. That's an enormous return. It's way better than what the stock market is doing because it's leveraged. Now, here's the crazy thing. You're going to get some cash flow, and I'd already told you that the cash flow numbers aren't great right now, right? I mean, they're somewhere between 6 and 8% returns, not that much. But there's a 25% return over here. It's a quarter. It is 25%. It's a quarter of your invested capital. You get back year one. Now, again, you don't get that money unless you sell the asset, but it's the exact same thing as a stock. You don't really get a capital appreciation unless you sell the stock either. You have to sell the asset. The difference is that it is easier, more liquid, far more liquid to sell a stock than it is to sell real estate. But if we're comparing apples to apples here, okay, the stock, which may have been producing over the last many years, probably producing very well, somewhere between 10 and even 14%, is still getting its clock cleaned because I've got 25% over here in the exact same bucket. That stock that produced that type of gain probably doesn't have a dividend, but my real estate does, of somewhere between 6 and 8%. And even if you have a horrible time with your tenants and it takes all of your cash flow to run this thing, it's still a 25% return. And oh, by the way, those horrible tenants that were in your property were paying off your property a couple $1,000s a year, which is not horrible. I mean, usually ends up being somewhere between 3 and 6% return. And you also get to depreciate off of your taxes any gains that you have. So you get tax-free income, which you can't do with a stock. When you add all of those returns up, you can be somewhere between 30 and 40% realistically with real estate. Can't do that with stock unless you're a day trader and you're really good at it and you don't tell anybody about when you lose. And the crazy thing is the appreciation in real estate is the same as in the stock market. When everything went to hell back in 2008, stocks dropped, real estate dropped. Big difference is that when the capital appreciation turned into depreciation, the stock just simply lost value. The only value it had, it lost. That's not what happened to the people who were holding real estate. Their appreciation turned to depreciation, but they were still getting cash flow. They were still getting principal reduction. They were still getting tax benefits. All of those returns were still producing results. While both of these assets had to recover their value over time, the people who owned real estate got paid the whole time. Now, there's a host of other reasons why you would want to own real estate, but just the numbers alone, there isn't another investment that you can buy that comes anywhere close to comparing, which is also why, like I said in the last podcast, I believe that owning a home is a great place to put your money. Because when you rent a property, you're paying the equity and principal down. You're paying the principal down, increasing the equity for somebody else, not yourself. But as you live in your home, you're paying your equity down and the appreciation is increasing for you. And while, yes, you have to maintain it and it's expensive and you have taxes and all of the other things, fine, I understand. All of that included, I'll take that over paying rent any day of the week. I just flatly disagree with anybody who is, and especially since almost everybody who is suggesting people should rent properties, they themselves own rental properties that they take advantage of somebody paying them rent. It's comical on its face. So, why are so many people still investing in real estate? Well, there's the numbers. On top of the numbers, you have the fact that at the beginning of this, we talked about inflation. There are few hedges against inflation better than real estate. So then you've got the control, right? You actually control, you own 100% of it. You control it. You can do with it what you want. Can't say that about a stock. There's no CEO of your house that's going to say something stupid and tank the value of your house. It's one of the only assets that I'm aware of where you can actually get a third-party valuation that proves what it's worth before you buy it, that you're paying at or under market value for it. It's pretty cool when you think about it, really. It's one of the only assets that you can insure against downside risk. I mean, I guess you could on your stocks, but nobody does. But everybody insures their houses against downside risk. Everybody. So if my, $500,000 house burns to the ground, no big deal. The cool thing, it's included in all of my numbers in my cash flow numbers, so I still cash flow after the insurance. There's so many reasons why insurance is a superior investment vehicle. It's one of the greatest stores of wealth. It has created more millionaires than in anything else other than businesses over the years. If you want to get started, reach out to us, invest@rpcinvest.com. And listen, if you have things that you'd like for us to cover on the show, just let us know, invest@rpcinvest.com. And we read all of those emails. And as you have heard, we actually do shows on what you want to hear. This show really is about you. It's for you. And I really want to continue to deliver content that you guys want, need in your lives. So if you have something, let me know and we'll do a show on it. Got a few people that I need to bring on the show. See if I can get them on in the next little bit. They'll be fun shows to have some of my friends on and chat about real estate and business. Till next time, everybody, get out there and make something happen.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.